Good morning, everyone. My name is Elena, and I work at the Kansas City, Kansas Public Library. And this is our second part of our program, Exposing the Myth of Retirement Investing. Our presenter is Mr. Hartzler. Hello, let's welcome him to our program. And Mr. Hartzler, the stage is yours.
Thanks, Elena. So this is the second of 3 hours of presentation. We'll go about 45 minutes or so today. Several weeks ago, we talked through the first segment. I want to review that very quickly. So if you haven't been on before, you can kind of see where we're going with all of this. Can you hear me clearly? Am I coming through okay?
Yes.
Okay, good. So the title of the whole presentation is Exposing the Myths of Retirement Investing. And as I've been retired for about 13 and a half years, and what I've discovered over that period of time is that many of the things that I've been taught, and probably you have been taught over the years about investing as a senior, as a retired person, are costing us a lot of money, and they really aren't true. And so I wanted to expose some of those myths. And we talked a little bit about that the first time. For example, some of the myths are that seniors should move away from stocks because stocks are too risky. That's a myth. I don't think that's right. Stocks are too risky for senior investors. The investing time frame for seniors is relatively short. I don't think that's true. Senior investors cannot recover from market downturns. We've talked a little bit about why that isn't true. And then we didn't talk yet about that. We'll talk about that next week. And that is the withdrawal rate. How much money can you withdraw from your investments in your retirement years to support your lifestyle and still maintain the proper position in your investment? So those are the kind of things we're going to be talking about. So the first thing we talked about, first thing we talked about was the planning horizon. And this chart just talks about the life expectancy. If you retire at 65 and you're a couple, you have about a 48% chance of living another 25 years. So it's a long-term horizon. We're just living longer these days. And if a part of your legacy you want to pass on to the next generation or two, their planning horizon is going to add another 20 or 25 years. So you're really talking usually about 20 plus years of time horizon. And that's not short. So you should think long-term, continue to think long-term rather than going to a short-term strategy. So then we talk about, well, okay, who would you like to have make this presentation? My first choice would be Warren Buffett. He wasn't available. So we had quotations from him, and he's saying that 98% of us should be investing in this manner. We ought to pick low cost, and we'll define that today, diversified, and we'll talk some more about that today, index mutual funds. So that's the field we ought to be playing in, and we'll unpack each of those 4 things as the presentation goes on. But that's his advice to us, and that would be my advice to you. Low cost, diversified, index mutual funds. That's where you ought to be. Then we talked about the basic investment options, individual stocks, individual bonds, stock mutual funds, and bond mutual funds. And this is the area we're going to play in, stock mutual funds. Now, the reason we're going to play in that is that this graph shows very well, if you invested in 1926, $1 in these various strategies, you would have somewhere between $7,000 and $20,000 today. If you invested in government bonds, you'd have $142. Treasury bills, $21, and inflation would have grown that $1 to $14. So where would you like to be? Well, this graph would say, well, it's ridiculous. I mean, I want my 7, probably 10,000 is a good average between those two. I'll take the 10,000 versus the 142. I mean, it's just ridiculous. Why should I not be in stocks? Why are people advising me to go into these kind of investments in my later years? Well, the answer is, stock market is very volatile, and these kind of graphs have a logarithmic scale over here. So in 1926, you can see wild fluctuations in the stock market because you're on a scale of $1 to $10. By 2008, this is the period I lived through, just soon after I retired, which is terrible timing. That's about a 50% reduction in value if you talk about 2000 and 1000. So the scale throws it off. This is a very jagged path upward, and that's what throws many people off. Now here's a graph we talked about. Most of the time, the white areas are bull markets. The stock market is going up. The dark areas are the bear markets where the market is going down. Here's 1929, obviously the worst one in our lifetimes, or in recorded history, really. Most of the time, you'll see the stock market going up. But during the year, we'll talk about that today more, the stock market may take a hit. So the stock market is very volatile, but it is your friend. Most of the time, it's going to be going up, and you'll see gains. This then talks about returns and various strategies. Here is a 1 year return on average if you own stocks. The worst year in this period, 1950 to 2018, that's 68 years, you would have lost 39%. I know what year that was, but the best year you would have gained 47%. Okay, very volatile. Here's bonds, here's a mixture of stocks and bonds. But if you move to a 5-year rolling average, the chances of losing money over a 5-year period is minimal. 10 years, almost none at 20 years, which is our planning horizon. You might as well be getting the 17%. And the stocks over this 68-year period averaged 11.0%. Bonds averaged 5.8. Well, what does that mean? Well, that says if you started with $100,000 20 years later, in stocks you'd have 800,000, in bonds you'd have 300. So you say, well, let's move toward bonds. Really? Do I want the 300,000? Do I want the 800,000? It's a no-brainer. I'm staying in stocks. Then we define risk. We spent some time on that. I break risk down, and that's the risk of investing. There's a business risk, a systemic market risk, and an inflation risk. The business risk is the chance a business fails and you lose your money. Okay, you start a restaurant, it failed in 2020. That was a common story. You lost all your money. The antidote to that, of course, is diversify through mutual funds, own lots of companies. Then there's systemic market risk where the whole market takes a dive. That happened in 2008, 2009. Well, the antidote is limit the number of shares. Don't pay attention so much about the dollar value. Limit the number of shares you sell so that the number of shares you have is maximized. And when the market comes back, you get those gains also. And then finally, inflation risk. Safe investments, like we talked about before, government bonds and so forth, are eroded by inflation. And so the antidote for inflation risk, which is the one as a senior I fear the most, is inflation risk. I invest in stock mutual funds. That's the way to beat inflation. Then we talked about understanding the stock market. There are 5 major topics. We covered the first 2 in the first session, and that is the market is a bid and asked auction. And we talked about the folly of trying to beat the market. The market is going to give you a good return. Why do you want to beat it? Well, it's greed. So then we talked about the actual buying and selling of stocks. Nobody establishes the price except the buyers and sellers. So the interesting point is that you have to have a willing buyer who thinks the stock's future is bright. You also have to have a willing seller who owns the stock and thinks the stock's future is dim. He's willing to sell. And ironically, given access to the identical historical data, it's all available to everybody at the same time, there is perfect disagreement. Somebody thinks stock's future is good, somebody thinks the stock future is bad. And if that happens, they both must agree on a price or there's no deal. Of course, there are deals made every day. So it's an interesting bid and asked auction. That's how stock prices are determined. The government's not doing it. The companies are not doing it. The stock market, and it's a bid and asked auction. Now, we talked a little bit about the cost. There are 2 types of mutual funds that you can invest in. There are actively managed funds. There are passively managed funds or index funds. These are the ones that Warren Buffett is recommending because the actively managed funds pick which stocks to buy and when to buy and sell. and doing all that research costs money. So their fees are 1% to 2%. I've seen much higher, but that's a general range. Passively managed funds, the index funds, just buy and hold a broad range of stocks that mirror an index. So maybe a S&P 500, maybe a world index, NASDAQ, and so forth. And the fees here, because you're just buying whatever the index is, range from 0.1 to 0.3. And the difference between 0.1 and 1 or 2% per year, compounded over 20 years, can be a huge difference. So that's why Warren is saying low cost. He's talking about passively managed fund index funds. And we talked about the folly of trying to beat the market. It's not a one-on-one competition. It's you against the world. You've got to buy at the right time and price and sell at the right time. You've got to be right twice. It involves foretelling the future, and that's proven to be very difficult. And this is the last chart that we covered in the first period. This shows how difficult it is to beat the market or the benchmark. And this is over a 15-year period. These are 2,828 different mutual funds that are actively managed. And over that 15-year period, a whopping 14% actually beat the benchmark. So 86, if you invested in index funds that just got the market, you have an 86% chance of getting the market if you buy actively managed stock funds. And these are experts. So the experts got 14% of them actually beat the market, 86% failed. I don't like those odds. So that's the difficulty in beating the market. So now we'll take some more time with these next slides, and we're into today's presentation. Any questions? That's a lot of data if you haven't been through the first hour's presentation. So feel free to jump in at any time. So as you'll see in later graphs, over the 94 years or 96 years, 94 years, that we've had really good data on the stock market, going back to 1926. The stock market, if you just bought the market, and that's what we're really advocating here, you would have gotten about a 10% rate of return on average. Now, any one year, very unlikely you'll get exactly 10%. It'll be much higher or much lower. And I'll show you what that looks like. But about 10%. Well, most investors get half of that or less. So we need to look at the reasons why investors don't get market returns, because they're available to you. And then you'll know how to avoid those pitfalls. And the primary reason has nothing to do with mathematics. The primary reason people don't get market returns is human emotions. And two human emotions are responsible for that. And they are greed and fear. So the greed, and again, we're talking about a bid and ask auction. So people are looking to the future and they're saying, oh my gosh, stock market is going up. I need to get some of this. So I go out and I buy stocks and I drive the prices up. So greed drives the market to unsustainable heights. Irrational enthusiasm, right? So stocks are making others rich. I need my share and I buy in as the market is going up. Then the market inevitably tanks, and fear drives the market to unrealistic lows. So at any one point in time, the value of your shares is probably going to be higher than it really should be or lower than it really should be, because the stock market prices are driven by people who have these human emotions, greed and fear. So now the market's going down, I'm losing my shirt, and I sell to avoid losing my skin. Okay, so these two human emotions need to be tamped down, they need to be controlled, and that's what a financial advisor should be doing for you as a counselor. Now, this second hour of the presentation is supposed to be a lot easier to understand, a lot less numbers and a lot more human emotions. And the second slide I show you is one of the busiest one of the whole presentation, but I love it. I think it's a great slide, because if you understand this presentation here, you'll understand why people don't get market returns. So if you look on the left-hand side, you will see dollars that measure what these bar graphs show. And these are the flows of money into or out of the stock market. And you see most of these are quarters. So most of the quarters from 1999 to 2020 are positive. Money is flowing into the stock market most of the time, okay? And this is the S&P 500 performance. The right-hand index shows the S&P 500 value over time, and that's the line. So this line shows where the stock market is measured by this particular index, S&P 500, is going up and going down and so on and so forth, okay? So you interpose those two, and I have to emphasize that these little bars represent a lot of money. These are 60, 80, 40 billion dollars a quarter flowing into the stock market. Now, normally, as our economy grows and so forth, there's lots of money that just automatically goes into the stock market. If you're into IRAs, if you're into 401k, 403b, all the people that are employed and have those plans, there's money going in every month or quarter or whatever that the company's putting in of their money and the company's money in many cases. So there's a natural inflow of a fairly significant amount of money into the stock market anyway. To drive the flow to a negative, you have to first offset all those inflows. I mean, people sign up for a 401k plan and they go on autopilot, right? They don't do anything and just let it happen, which is a good thing, actually. So to drive it into a negative, and this was the dot-com bubble that burst, it takes a lot of outflow. This is huge, $20 billion, but it's that plus the normal inflows that offset. So this is a huge factor here. So these numbers are very large. Now, if you look at what happens in the market, this was the dot-com bubble. Things really hit a rock bottom. People panicked and they got out. But after that, the stock market went up and up and up for, what's that, 8 years or so. And lots of money flowed into the stock market. So people are saying, well, the market's going up, I should buy, greed takes over, and so forth. Now, this is my favorite period of time because I chose to retire in September of 2007, and I started taking money out of the stock market to live on in January of 2008. And of course, the stock market immediately plunged about 50% in value from there to March of 2009. Well, what happened there? Well, as soon as that started to happen, you see not just one downturn, you saw money flowing out in huge amounts almost every quarter. So what people did is they bought in as the stock market was going up, they sold out. And when it hit bottom in March of 2009, I mean, there was huge amounts of money flowing out of the stock market. So where people were buying at a high level, selling at a low level. Well, that's not a good strategy, okay? I mean, you need to buy low and sell high. Well, they were buying high and selling low. That's not the worst part. The worst part is, and again, these are significant numbers, throughout the recovery period from 2009 until the market got back in 2013 to its former level, you saw mostly outflows. A few times people got excited, but mostly funds flowing out. So not only did they get out of the stock market when it down, they kept selling as the market went up. And only in 2013, when the market got back to where it was at the peak before the financial crisis, only then money started flowing back in, huge amounts of money. So again, these people are buying high, they're selling low, and they're continuing to sell as the stock market. And so they missed all of this run up. Okay, now they get back in, and of course the market goes up. You have a little dip here, and people are continuing to get out of the market. The market's going from a low point here of about 900 to 3,000. I mean, a tremendous 11 years of prosperity, and you see these kind of numbers throughout that period. So again, people sell at a low period, they buy at a high period, makes no sense whatever. And this ends in a glorious time, 2020, and you know what happened in March, this is March of 2020. you had a dive. Well, where is it today? I checked this morning. S&P 500 is at 3,800. So it's up here. And all these people have sold. So I looked and I had a Reuters announcement, March 13, 2020, about the peak, about the end of this period here. And it says that investors allocated a record 137 billion, that's with a B, to cash-like investments out of the stock market over 5 days ending March 11th. And it says even government bonds that 14 billion went into government bonds, 3 billion went into gold. So people are bailing out of the stock market and going into things like government bonds. And of course, then immediately in 2020, we ended it higher than we had here. And today, we're still January, we're at 3,800 in the S&P 500. So it's incredible. So this explains why people's emotions get a hold of them. They get greedy during these periods of time. They get spooked during these times, and they're buying high and they're selling low. And that is the primary reason. So I love the chart. If you understand it, it tells you everything you need to know about why people don't. So what's the lesson? Well, the lesson is you buy into it, you pay no attention whatsoever to the prices. You can't control that, and you control the number of shares. And the rest of the presentation today and next week, we'll talk about, well, how do you control the number of shares that you have? Now let's talk about another concept Warren Buffett is espousing, and that is you have to diversify. And so that's an important term. Well, what does diversification mean? I coined a couple of different phrases because I didn't really understand it for a very long time. And I've termed this defensive diversification. So the defensive diversification is to cover one company's failure by another company's success. So for example, if I buy the stock in one company, and I started out my investment career doing that, I bought two companies actually. One went bankrupt and the other did nothing. So I had a lesson very early on. I hadn't had very much money to invest, which was a blessing. But I said, okay, I buy one company, it goes broke, I lose all my money, right? So I'm not going to do that again. So if you bought 50 companies and one of them went bad, then you'd have 49 to cover and you'd be okay. So 50, 500, whatever. That's defensive diversification, ensuring that one company's failure is covered by other companies' success. Several years ago, I kind of got the idea of offensive diversification. I've got a chart or two to show you on that. If you look at the stock market, it goes up, let's say it goes up, last year it was up about 15%, depending on what index you're looking at. So it goes up 15%. Well, why is that? Well, the fact of the matter is that 90% of the stocks that I own, and I own 10,000 through mutual funds, I own about 10,000 stocks. 90% of those are bumping along fine. And they're making a profit. They may pay some dividends, and their rate of return is probably 5%. Well, the market's 10, 15, in fact, in 2020. Okay, well, what made that happen? In any given year, about 10% of the stock. So instead of 10,000, there's 1,000 that really moved the market. In 2020, it was big tech stocks. They moved the market. So if you owned those 10%, then you got the market returns. If you missed out on the 10%, you didn't. And so owning 50 or 500 companies gives you very little comfort that you will actually own 10%. Now, if I knew which 10% that was going to be, well, I just buy those, right? And I make tons of money, but I don't know. Nobody knows. But we'll be surprised in 2021, about 10% of the stocks will move the market. If you don't own those 10%, the stocks, then you're going to miss out on the market returns. So that's offensive diversification. I want to get those 10%. How do I do that? I own the entire market. Here's a graph that shows that. This is 94 through 2017. So if you own, it was not a good period of the stock market. But if you owned all the stocks, you got an average of 8%. If you missed out on the top 10%, you got 3.6%. And if you missed out on the top 25, you actually lost money during that period of time when you should have made 8% on balance. So it's very, very important to own the top 10 performers. You don't know what they're going to be. You got to own them. How do you offensively diversify so you make sure you get the 10%, you own the entire market. So that's what Warren Buffett is espousing, and that's what I would tell you to do. The next topic is the perils of being out of the market. So people who buy and sell stocks, oh my gosh, the stock market is going up. I'm going to sell, lock in my gains. I'm going to buy later on. So people who are buying and selling, there's a peril. You do that at your own risk. And the point is that the stock market is not only volatile year to year. Last year was plus 15%. Year before that it was flat. So the stock market is not only volatile year to year, it can be volatile day to day. Big gains or losses can happen in a day. It's just incredible. So here's a chart that it's just almost unbelievable. This is the S&P 500 again, between January 4, 1999 and December 31, 2018. So you're talking about 19 years, right? So over that period of time, if you were fully invested, never bought, never sold, you got a 5.62% return on the S&P 500. Now, the thing to remember is that over this period of time, there were about 7,000 days of trading. And if you were in the market for those 7,000 days, you got a 5.62% return. If you missed the 10 best days, 10 days out of 7,000, you got a 2% return. Incredible. If you missed 20 days, you actually went negative. So you have to be in the market on those best days. 6 of the best 10 days occurred within 2 weeks of the 10 worst days. So people look at a horrible day, they sell out, and guess what? It comes back within 2 weeks of that. The best day in 2015, August 26th, was only 2 days after the worst day, August 24th. Can be very volatile. If you get in and out at the wrong time, you can get absolutely hammered. And it's just amazing. 10 days out of 7,000, if you miss them, you got less than half the returns that you should have gotten. So that's very, very interesting graph. So you got to tame the emotions. Stocks have returned about 10% per year on average for 93 years. We have pretty good data going back to 1926 to 2019. And then most investors get much less, and this is including the professionals, incidentally, who think they can project what's happening in the future, and they can't. And I can do all the mathematics I want to tell you, well, you could get this 10%. Well, you can, but emotions, if they get in the way, can trump the math every time. So you got to tame the emotions. You got to have help doing that. This is another, in fact, I promise you it's the last complex graph that we have. But it's a wonderful graph because it illustrates how volatile the stock market really is and how difficult it is to tame the emotions. So the bars here are the annual rates of return. So in 1980, back in 1980, if you held stocks throughout the year, at the end of the year, the value of the S&P 500 index anyway, would have been 26% greater than it was at the start of the year. So that's a positive return of 26% for that year. Now in 2009, it was minus 10, 1981, 82 was 15%, 83 was 17, and on and so forth. So you see, most of the years you get a positive return. Now here's the dot-com bubble. You had 3 years where you had negative returns, but most of the years ended in a positive return. Say, okay, well, that's great. And my 10% is running through here. However, During the year, okay, the intra-year saw declines in every year. So these little red dots show that sometime during 1980, a year that ended in a positive 26% rate of return, sometime during that calendar year, the stock market had hit a minus 17. It was down 17% from where it started. Now, at the end of the year, it's going to end at 26%, but sometime during that year, it went down 17%. Here we had a negative 10% at the end of the year, and at a point during the year, it was down 18%. Again, positive return, but sometime during the year, it was down 17%. Okay, go back and look at my favorite time, 2008. At the end of 2008, down 38%. There was a time, and I know when this was, when it was down 49%. So you see, even though there are many good years, during that period of time, every year there was a time where it was down a significant amount. Here's a good example. That was 2008. No, that was 2009. It ended the year at a positive 23%, but in March of 2009, I remember that time, it was down 28% from the start of 2009. So the point I'm making here is that every year there is a time where the sky is falling. And of course the talking heads and all the business networks will be saying, oh my gosh, we're down 14%, we're down 20%, we're down 30% for the year. What do we do? You know, where do you find comfort? Well, most of the time you end up with a great return, but you have to go through these periods, and every one of those red dots represents a period where people, that, you know, fear takes over, the sky is falling, and they're tempted to get out of the stock market, and many of them do. So you know, it's just we saw earlier what happened in 2020. Well, you know, in March it was way down. People bailed out. At the end of the year, we're up 15% on average. It's just incredible. The average intra-year drop is 13.9%. So if you wake up and the business news says, oh gosh, from the start of the year, we're down 14%, you should say, well, okay, it's kind of average. That's kind of what we expect. No big deal. So that's the point there. It's a busy graph, but it tells you lots of opportunity, even during the year, during a good year, of bailing out of the market. And again, you have to tame those emotions. So that's a lot. I want to summarize it here with 4 points. In what that prior graph shows is in 3 or 4 years, the stock market goes up. So most of the time you're looking good and it feels good. It may go down in a given year, and it may go down for 3 years in a row, as this period showed. It's highly unlikely the year will end with an average of a 10% increase, which we said for 93 years. That's what its average will. What's the chances it will be? Well, let's look at that graph. Where do you see a 10%? Once. In all those years, only one time did the stock market actually return 10%. It's wild. And the average intra-year decline of the S&P 500 anyway has been 13.9%. So that is the last slide I have to show today. Let me get it. Here we can go back and look at any one of these slides you want to look at, but that's all I had to present today. So if you'll unmute questions, I'd be glad to review any of the stuff we talked about today or the first session or so forth. Anything that's confusing, anything that you disagree with. Hopefully this has been instructive for you, but let me hear from you.
Anybody?
Is everyone still awake? That's what, can we check?
I have a question.
Surely. Yeah.
I do work with a financial planner, and you know, my husband and I have some mutual funds through them, and I've always had a hard time determining exactly what the annual fees are on those, on our accounts. And I don't know that I'm always concerned that the fees that we're paying are too high, because I think we do have an actively managed account. And the more I learn about this, the more I learn that really the best thing to do is passive, like you've said, and low fees over time.
Fees matter.
Yeah.
And the industry is very, very highly regulated, but I'm not sure how effective it really is. If you buy a mutual fund of any kind, the report you're likely to get from them is going to show what your rate of return was net of those fees. So I think, and maybe this is cynical, I don't know, but I think most of these mutual fund companies do not want you to know what their expenses are. They
It
just
seems
take
like
it out of your account and
it
show
seems like it's
you.
hard to figure that out.
Now they know what they are, and your financial advisor should be able to tell you exactly what you're paying for these funds. That information is available. You have to dig for it, and you
Yeah.
should ask your financial advisor, and we'll cover that next time in more detail. But
Okay.
and there are four things you ought to know from your financial advisor. We'll go over that in detail next week. But that you have to dig and you have to find out. And so generally actively managed funds, you're going to have about a 1% of your outstanding balance of investments per year. That's normal.
I want to
If
say I have in my head it was like 1.5%.
Yeah,
And
that's pretty normal. Now, if you get into
okay.
international small cap emerging markets, some of the more exotic things, you can go to 2 to 3%, because obviously it takes a lot more time and effort to research Guatemalan stocks. It's not easy.
Yeah.
Okay,
Yeah.
so if you're owning the market, you're going to have some of that. So you're going to have to deal with some of that sort of things. So I think yeah, that's next time. But normally 1 to 2% is normal. If you get into index funds, you can buy index funds at 0.1%. I say fair. The funds that I'm in are kind of a market-based funds, and they run about the 0.3 basis points or 0.3%. 30 basis points are about 0.3%. So about a third of or in your case, about a fifth. And that difference can make a big difference.
Yeah. So would you recommend, I mean, is it better to maybe move out of that and into something that's?
I think about 80% of the mutual fund money is in active funds, because it's
in active funds?
Yeah.
Okay.
But that's changed. It used to be 85%. I think it's down to about 80% now. And I think we see people say, well, if everybody went to index funds, there wouldn't be any market. And that's true.
Yeah.
But greed is always going to trump. It's the American way, right? It's like Lake Wobegon, right? We're all the women are strong, all the men are good looking, and all the children above average. I mean, we to say, okay, let's just take the market return. Let's just get average returns. They say, well, I'm going to be average. I'm going to be better than average. So there will always be people saying, hey, I can beat the market. I can get you better returns than 10%. I can get you 11, 12, 15, whatever. Well, they can't, not over a long period of time. Nobody does that. But it's a siren song. I mean, I want to be better than average, So it's a hard thing to fight against. But if you take investments over a long period of time and you get 10% per year, my Lord, I mean, it's the miracle, the eighth wonder of the world, according to Einstein, is compound interest. And I need to include a slide. I've got one somewhere. I need to include it in this presentation. The difference between simple interest and compound interest. Compound interest is just amazing. If you just, for example, my son, he's not a sophisticated investor. He uses the same financial advisor as I do, and we talk a lot about it. But he's a great guy, and he retired from 28 years in the police force and started his own business, which I would never do, and had been very successful at it. But when he was just starting to work, I said, "Well, Jeff, you need to invest in an IRA and put some money aside for your retirement." He said, "Well, sure, Dad. I can't even make the truck payment." So he wasn't making much money. So I said, "Okay, fine, Jeff. We are going to fund your IRA to the max." Back then, it was $2,000. So we put in funded an IRA for him. He was 22 or 23 years old. $2,000 a year, and we did that for 4 years. Well, then he got promoted, and he was starting to make a little bit better money with the police department. I said, "Okay, you're on your own. You've got your police pension fund and so forth. We're not going to put any money into it." Well, that $8,000 that sat there, compounding earnings in the mutual funds, and today he's 57 years old. And I asked him, "What's that fund?" It's about $175,000. $8,000 is all we put into it. He hasn't touched it. He hasn't taken any money out. He hasn't put any more money in. And that IRA account is about $175,000. I mean, it's incredible. It's just incredible. So that's my alarm. So this 10% a year, I haven't done, because I've had some expenses. I've averaged about 9.5% per year over 55 years of investing. But you take that kind of rate of return that the market's very willing to give you, and you compound it. It's just unbelievable. So we'll talk some more about that next time. But trying to beat the market is a fool's errand. If you can get at a cost of 0.1 to 0.3% per year, an index fund or funds, you'd have to have several. It's going to be a wonderful rate of return, but you have to be very disciplined. You can't come in and out of the market. You can't be driven by greed or fear. You just have to be very disciplined, and over a long period of time. And even those of us who are retired, who have a long-term planning horizon, you're going to do just fine. I mean, it's going to be great. So we'll talk about some specific numbers more next time. But good question, and I would just challenge you. Could we lower our costs by a percentage a year? That's over a long period of time. That's huge, just by owning, index funds and covering the whole market by owning. So I own. It's kind of different. I changed a little bit for a lot of reasons about a year ago, but I now own 3 mutual funds, and in those 3 mutual funds, they cover about 10,000 stocks. So the last 10 years, I've owned somewhere between 10 and 12,500 different companies. So I'm very highly diversified. My costs run about a 0.3% per year for market-based index type funds. So that's what I'd recommend.
So how do you know what stocks are top performers? Because market is high today and very low tomorrow. You can lose pretty much everything. So how can you judge which ones are top performance, as you recommended to invest 10% in top performer stocks?
Yeah, exactly. So it's interesting because, as you saw one of my graphs, which one was it? Yeah, this is over a 15-year period. Okay, the professionals. These are mutual funds managed by highly paid professionals. 14% of them actually beat their benchmark or beat the index. So they're saying, we can actively manage. We can pick the stocks. These are not just you and me. These are professional people. 14% over a 15-year period exceeded the market. 86% got less than the market return. So if you turn on the business news, one of the exercises I have people do often is to say, okay, just listen to the business news for a few days, for an hour. I mean, don't waste a lot of time, and just clock how much of the time they're talking about the future and predicting the future. The entire business news is all about, what's going to happen, what stocks do I pick, what stocks should you hold, what stocks are going to go up, which ones are going to go down. They spend all their time predicting the future. And in fact, this shows that nobody can do that. Even the professionals are abysmal at trying to predict the future. So again, just buy an index fund, hold it, manage the number of shares you have. Don't worry too much about the price, and you'll be just fine. You'll get this 10% over a long period of time. And you hear all these stories about. I was looking at the internet today. We're saying the guy who bought Tesla stocks when it was a small company, and now he has $12 million. He's retiring and he's 39 years old. I mean, it was, wow. Well, okay, but let's not confuse wisdom and knowledge and ability with pure blind luck. Yes, that's a story. It's a very nice success story. His rate of return is probably in the 1,000% a year. There's blind luck. I mean, who knew? I mean, there are still people predicting today that Tesla is a fool's game and will crash and burn. Most people don't believe that, obviously. It's Tesla stock, and Elon Musk is now is the wealthiest person in the world. So, but who knew to buy Tesla stock? The original two stocks that I bought when I was in graduate school back in 1968, 69, one of them failed miserably and the other never really has done anything. The third stock I was really looking at was McDonald's, and I failed to buy it. Well, had I bought McDonald's stock in 1969, in any measure whatsoever, I'd be a lot wealthier today. But I didn't know McDonald's was going to be the chain that it is today. I mean, again, I'm no good at predicting the future, and I admit it. So they're fool's errands, and that's what this slide shows.
Well, we can have another 5 minutes of us answering questions. If anybody has any questions, please ask.
Well, if not, come back next week, and we're going to talk a lot of specifics now. When I introduced this thing in the first presentation, I tried to explain my credentials, and they're pretty weak. I mean, I never really worked in this industry. I've been a financial advisor now for 13 and a half years in retirement, but I do all of my work pro bono. I don't get involved in actually recommending buying and selling stocks and things like that. So I really have no credentials to make this presentation, except that I did retire again in August of 2007, started taking money out of the stock market in 2008. And I'll show you some data next week that says that was the second worst time since 1929 to retire. So I picked the second worst time. It was almost the worst period to retire. You never want to retire and then have the stock market immediately tank. This doesn't bode well. Your financial advisor will tell you that. So I went through the worst time in my lifetime practically and experienced that. And yet today, I can show you where I am, and I'm just fine. Okay, so the analysis that I'll show you today is I picked out the worst times to retire and market tested that, back tested that, and say, well, if you just had bad luck like I did, okay, how would you come through that? And it's amazing what that chart will show. So just staying the course, and we'll talk about the specific numbers, even if you had bad luck of bad timing, and I've tested what that would look like, and I come back to the same strategy: own stocks, own the market, and hang in there. And we will talk then about, well, okay, what is how many shares can you sell? What withdrawal rate in retirement is safe? And at what point in time do you jeopardize this, your future balances? So I'm going to spend a lot of time talking about that. And that's another myth. People say, well, you can 4% is the number that's taken out. In good times, 8 or 9 is fine. Bad times, 6 is still good. 7 is probably still good. So we'll talk about that in more detail next time. So come back.
Well, thank you very much, everybody. And thank you, Mr. Hartzler. That was very, very interesting and I hope very, very useful for everybody. Please come back next time, next Tuesday at the same time at 10 o'clock for the last part of this seminar. And we will record this part too and post it on our programming blog. And as I ask everybody, please email your email addresses to Mr. Hartzler in the chat if you haven't done that yet. Or you can always email them to me. You can find my information in the programming blog, I believe. If anybody is interested in talking to Mr. Hartzler afterwards, as he said, he is a pro bono advisor, so it will not cost you anything. So if anybody wants to have a free conversation, free consultation, feel free to contact him. And maybe it will be better just to give your contact information next time during our third part of the presentation.
Thank you all for listening.
Thank you very much, and we will see you next time. Have a great rest of your week. Thank you. Goodbye.